So, Greg, at a high level, what requirements need to be present in order for somebody to qualify to capitalize on a 1031 exchange tax deferral?
They need to have the intent. There's very few words. Very few words. They just need to actually. They need to know two words. They need to know what does like kind mean and what does exchange mean.
Right.
And as y'all know, as brokers, you have the 1031 expert answer those questions for them. To set up a 1031, all it takes at a minimum is for your client to have at least one conversation with a 1031 specialist and the contract and the title commitment. And but again, getting back to whether it qualifies or not, that conversation, they need to have held, they need to have the intent to hold and held an interest in real property anywhere in the country, this business or investment, and then they can sell it to whoever they want. And then the only thing that makes it an exchange is that you've gotten our documents at the closing. So you absolutely, as y'all know, you have to have 1031 documents at a closing. So you can do it. You can sell any investment real estate or business in the country, but you can't do that in a way that gives you either actual or receipt of your funds. It's kind of like a retirement account roller. Yeah.
I view the accommodator's role or as a facilitator of sorts, much in the same way the title company is.
Right.
It's really synonymous. It's almost the same role, just in a different part of the transaction. But we can't go and close a deal somewhere else other than with the title company.
Right.
Right. I
Yeah.
can't really facilitate the 1031 exchange without the presence of an accommodator such as yourself. Right. It has to be formally in place. Can somebody who's selling some real estate and they're getting into a like-kind property, it has to be of equal or greater value than the previous one that they sold, correct? And does that apply to both the debt and the equity pieces of the total value?
It depends on if they want to defer all the tax
Okay.
or some of it. So to defer all the tax, you just take the sales price off the top. And then if there's debt, that's paid off, obviously. And then we hold the money. And all a fully deferred exchange is they reinvest all of their equity that we're holding, if it's all that they had, and they replace their debt either with new debt or additional capital. Some people think they have to maintain the same loan to value on the next property. It's just absolute terms. It's just absolute terms.
Oh, interesting.
How much was your equity?
Sure.
You got to spend all that. How much was your debt? You got to replace that either with more debt or your own cash. But a lot of people, as you know, move up. So it doesn't matter the percentages. Once you move up and reinvest all your equity, you've deferred all of the taxes. But that formula for deferring all of the tax has messed up so many people into thinking that that's all you can do. I hear that all the time, that you absolutely have to move up. No, that's just a real simple way for saying what you need to do to defer all the taxes is, if you move up and not touch any of your cash, you will defer all the taxes. But number one, you can take out closing costs. Number two, you can buy less. However, as y'all know, any amount you buy less is what they call boot, and it's taxable unless they have other write-offs. So most of my surprises for people, which are the same surprises to me when I got in the business, are positive, like how broad like kind is, and the fact that exchange doesn't mean you got to find somebody to swap with.
Sure.
A few negatives, I could say a few things that get under people's skin and almost argue with me like I'm the one that set the rules, is that they can't, by gosh, put their cost back in their pocket.
Right.
They're selling something for $2 million and they want to buy something for $1.5 million, and they only paid $500,000, and I tell them, well, that's taxable, and they go, no, that $500,000, that was my money. I put $500,000 back. You mean I'm taxed on what I put in? You're not taxed on your costs, but your cost has to go with you if you're not paying taxes.
Right.
So the whole point of that farmer example, the reason we got this in the code was if you're spending all your money, there's nothing to pay taxes with. So if you want to pull out some money, that's a regular sale, that part of it. So that's why that's taxed. Any money you pull out comes out of profit, not your cost. Many people who know quite a bit about 1031s, but maybe not everything, are very familiar with the 3 property rule. So we can talk about that, most common way of identifying.
Please do.
That's only one way.
Okay.
Yeah, if you pick the 3 property rule, if you only list 3 choices, then they can be of unlimited value.
What else other than the 3 property alternative? What's an alternative?
There's 2 more. One of them's good, one of them is not. And so you really almost never hear about the 3rd rule, and that's not bad that you don't hear about it. It's not considered wise to follow it, but the one that's good in a lot of cases is the 200% rule. If someone's buying maybe they're identifying a lot of different smaller properties, maybe, or if they're buying oil and gas interests, which is the biggest surprise to
Oil and gas will apply to the term like kind?
Exactly.
Interesting.
The second thing is the 200% rule. So if you want to list more than 3 choices, you can do that as long as you add up all of the values. That's a little nuanced. The values of what you're identifying, it can't be more than double your gross sales price.
Okay.
Yeah. When you mentioned land for development, I want to be clear about that. Well, first of all, of course, you can buy land if you're going to sit on it for a few years. But if you're buying it to develop, what I want to answer is that the reason it involves more questions, because if you're buying it to develop for resale, it doesn't qualify. Just as a regular, that's a dealer. But if you're buying a property to develop to rent out a couple of years, it does. Another probably one of my top 5 pieces of bad news is, even though the types of real estate that qualify is very broad, you have to get a direct interest in the real estate, as y'all know. And therefore, can you invest in a partnership? No.